Hi, this is David, Florida. Welcome to another episode of That's My Realtor. Don't really know what I'm going to be talking about today. The plan is to just drive around and get some donuts. Oh, look, there's Tom.
Hey, Dave, how's it going?
Oh, pretty good, Tom. A little
Good.
chilly out there. You want a lift?
I'd love a lift.
All right, jump in.
Where are you heading?
Glory Hole Donuts.
Nice.
All right, Tom, I was just telling the people out there that I was planning on driving around and talking about whatever and getting some donuts, but why don't we make this about mortgages?
That's great.
Would
I
you
don't
mind
at all.
Would you mind telling the people out there what function does a mortgage professional serve?
Yeah, so what I do for a living is, I help consumers just like yourself who are looking to purchase a new home, or consumers that currently own a property now that are looking to refinance. So I help them obtain a mortgage through a financial institution and, try to find them the best product along with getting the best rate, helping them save some money and, being able to satisfy their dream of home ownership.
Nice. So, what would you say is the major difference between going to a bank and talking to someone like you?
Yeah, so that's a great question. Going to a bank, you're dealing with the one institution that you walk into. They're gonna give you one product, the only product that they offer, and basically the one rate that they're offering. Whereas being a mortgage broker like myself, we have access to dozens and dozens of lenders, including some of the big banks, credit unions, trust companies, insurance companies. So when clients come to me, we can look at the big picture and determine whether or not a bank mortgage would be suitable for them, or looking elsewhere towards, like, let's say, a credit union or even a trust company.
That's what you would call alternative lending?
No, alternative lending is
Okay.
more about having not having that option of being able to go into a bank or maybe even a credit union for that matter. Usually, alternative lenders are for clients with maybe bruised credit.
Okay.
They may not have the best credit score. Maybe their income isn't confirmable, like someone who's on salary. Maybe their business for self, and they don't sort of fit within that box that some of the bigger financial institutions require.
Okay, and from what I understand, you're seeing more and more of that these days. Self-employed people and
That's
people
right.
in sort of unconventional jobs.
Correct, for sure. So, in the fall of 2016, the federal government implemented some changes. And with those changes, it made it a little bit more tougher for consumers to obtain a mortgage. So they are now, leaning more towards that alternative lending side. And going to an alternative lending side does mean, a little bit more risk for the lender, and in turn, they'll charge you maybe 1% or two higher than what you can obtain from, let's say, a bank.
Okay, but that's a way for someone like that to secure a mortgage where they perhaps wouldn't have been able to get a chance to previously?
Yeah, exactly.
Okay. Why don't you tell the people out there, what's the biggest question you get asked these days? What's a question that you get asked frequently?
Well, that's a great question too. So, pretty much the first question I get asked, if I get a call from a potential client, is, what's the best interest rate? And again, going back to some of these changes that happened, back then we'd be able to have one interest rate for, a whole group of different people, depending on, interest, depending on down payment or income. Pretty much, if you qualified, you get the same rate right across the board. And so now, what I'm finding is when people are asking me what the best interest rates are, it's a little bit more complicated than that. For instance, if someone decides that they want to put down less than 20%, which we call an insured mortgage, they'll get a preferred rate as opposed to, say, someone who wants to put down 20%. And the reason for that is the consumer pays a default insurance when they're putting less than 20% down.
Right.
And that default insurance basically protects the bank or the lender in a situation where the consumer defaults on the mortgage. So there's low risk involved to the lender when the mortgage is insured. So now if you're looking at getting an interest rate and you're putting less than 20% down, then your interest rate will be a little bit more favorable than if you were to put, say, 20% or 25%. So, when I do get those phone calls, you basically have to, find out what the client's intentions are and, whether or not they're putting a larger down payment. The property type also makes a big difference. Whether is it going to be a rental property, and also amortization. If they're looking at an extended amortization, which is from 25 to 30 years. So all those take play into what type of rate you're getting, and the big challenge for us is people go online and they type in best mortgage rates. So one thing that they don't realize is they might not fit within that box, and they get a little disappointed after the fact when they find out that their interest rate may be a few points higher than what they're seeing online.
Okay. Yeah.
Does that make sense?
Yeah, that makes sense.
Great.
So is there a rule of thumb, like based on income, how much would a person qualify for to get a mortgage?
Yeah, so if you're looking at putting down 20% or more and you want that extended amortization to, say, 30 years, the rule of thumb is anywhere from 5.5 times to 6 times your income.
Okay.
Right? And if you're looking at putting less than 20% down, then you're at around about 4.5 times your income. So to give you an example, if you're making $100,000 a year and you're putting less than 20% down, then you're looking at qualifying for a mortgage of approximately $450,000.
Nice.
Yeah.
Okay. And I got a final question for you. Do you like donuts?
I love donuts.
All right, let's get some donuts.
That's great. What kind of donut is that?
That one is London Fog. Has Earl Grey pastry cream inside of it. One of the best ones that we have. So good.
I'll take one of those.
Yeah, for sure. You like that on a tray for right now? I'd like to go.
On a tray. Be
For
great.
sure.
Actually, no, let's get a bunch. We'll bring them back to the office.
Okay, well, we'll just kind of do this as
Sure thing. Pardon me. All right. What else do you recommend?
We have the strawberry passion one. That's a strawberry and passion fruit cream-based glaze with some coconut flakes on top of it. It's also really good. And we have a couple of minis. We have the vanilla sprinkle made with real vanilla bean, and we also have the chunky cookie. It has a chocolate banana glaze with some sweet pecans and banana chips on top.
Are those Timbits?
Kind of. They're better than Timbits.
Better?
They're called the lemon ricotta balls. The ricotta cheese is mixed with the dough. Makes it like really velvety, really creamy, really rich on the mouth.
Yeah.
And then the glaze is a lemon and olive oil glaze. It's so good. And you see they're bigger than Timbits. So just starting there, they're better already.
Great. Take all those too, no?
Sounds like a plan.
Yeah, for sure. Also the tray.
Yes, please.
Yeah. All right.
Have one. Take one. One donut?
I don't want to ruin the
Go on.
photos and stuff.
No, it's what we want. That's good.
Ooh, moist. You can tell that was made with mud.